Okay, so we actually have two great back-to-back presentations, and I really enjoyed listening to Craig. David Jessop is our next speaker. David is currently at UBS as Global Head of Equities. Before that, he was at Citigroup as Global Head of Quantitative Marketing. And David, I've always wanted to be Global Head of something. I don't know how it feels to have, do you feel like this incredible power that 2 times this has happened to you?
No, it just means you get lots and lots of air miles.
Okay. That's not even bad. Before that, he was at Morgan Grenfell, where he managed index funds and a number of other kinds of funds. In terms of David's educational background, now some of you guys probably think that you went to schools that are really old, right? Maybe either 50 years old, maybe 100 years old. Well, David, as his undergrad, went to Trinity College in Ireland, which was founded in...
No,
Cambridge.
Pardon? Cambridge.
No.
Trust me,
I know you know what you did, but your bio says Trinity College.
Is this Trinity College, Cambridge?
So I'm not as impressed as I was.
It's
I mean,
about 1,300 and some.
So, no, exactly. Well, according to this, Cambridge is 1231. Does that make sense?
Trinity wasn't the first college.
Okay. So, well, I had all these ideas of like all these great Irish poets and playwrights and stuff like that. So, none of that rubbed off on you then?
Just to Isaac Newton.
Okay. All right. So, yeah. So anyway, so his schools are old. David actually he used to be a competitive ballroom dancer, which is why he looks like he does. He actually met his wife doing this competition. I don't know if he knocked her off the floor or what happened during that. And he is also an avid reader of science fiction and fantasy, and currently has a collection of these books that exceeds 1,000. Okay. He's got more than 1,000 books. So if you have any questions on that, aside from the serious stuff that we're talking about, please ask him. David Jessop.
Thank you. Actually, that's a much more entertaining introduction than I've ever had before. It was indeed Cambridge I went to. Which, as I say, just to give you an idea, just the room I stayed in my 3rd year was about 300 years old. It was built around 300 years ago. That's just normal. So anyway, what am I talking about? I'm from UBS. I'm on the investment banking side. And we're talking really here about using proprietary data and portfolio construction. And really, what's the backdrop to this? Well, this is sort of, I'm based in London, as you might be able to tell from my accent as well. And, you've got this backdrop of quant in Europe. Well, quant in Europe's done better than quant in the US. The blue line here, the one that ends at the top, is just a very simple combination of momentum, quality, value. But really, it hasn't done much the last few years. And so, our clients are trying to find ways of improving these sort of strategies. And, there seems to be 2 approaches. Factor timing, which Jeremy Baskin from Axel Rosenberg will be talking about tomorrow, is one approach, and the other one is really adding in sort of more proprietary data sources to try and improve these strategies. Now again, here, what I'm looking at here is sort of lower frequency. This is people trading daily, weekly, monthly. I'm not going into the high frequency area. So the first question we have is, here I am, I'm on the brokerage side. What data do we have? What's our proprietary data, really, that I can use? Well, the first thing that we have is this sort of leading set of analysts who hopefully know something about their companies. We have around 800 of them, especially in Europe. We've won Extel now for 12 years in a row. So you think that these guys probably have some information. And there's various things you can take from analysts. You can take their recommendations, their buy, their sell, their hold. And you can actually make money from that. You can take their price targets. Don't ever use price targets. They're dreadful. And also, we have this sort of process, this product internally called alpha preferences, where our analysts have to choose the best and worst stocks in their sector or in their coverage universe. And actually, that's the one I'm going to pick on. It's something we've been running out of sample, so real time, for around 4 or 5 years now. And there seems to be some information there. I'll come back to that. Trading data. We have our book, People Trading Options and Making Markets in Options. So that gives us a source of implied volatility data. And again, in the US, that's okay, but in Europe, single stock implieds are not really very good quality. There isn't really a very good source. So that's another set of data we've got. And again, it turns out you can make money from that. Flows, you know, we feel there should be some information in looking at the flows that we trade. I can tell you lots of good stories from them. There's a definite contemporaneous signal, but trying to find a really good lead lag signal or leading indicator there is difficult. There's something we have called the Growth Surprise Index, which is sort of a macro signal. I'll come on to that, again, describing it. And also, we run various proprietary surveys, which links perfectly to the previous talk. They tend to be very sector-specific and everything else. So there is information in them, but I'm not going to use them today as some examples. So that's the sort of data we have. So first of all, let's just go through those very briefly, given the amount of time we have. As I say here, our analysts, you know, we've got loads of sources of data. You've really got, I mean, basically you've got two things you can use analysts for. One is looking at revisions in one form or another. So data changing their forecasts, changing their recommendations, changing their, you know, their estimates of the balance sheet or anything like that. All of those things have information in them. Or as I say, we have this thing called alpha preferences, which is the one I'm going to use, which is the least and most preferred stocks in their sector. So I'm just going to say, for simplicity, focus on that one bit. So that's the performance of alpha preferences. This is, as I say, I'll say again, this starts in January 2008. This is a brain-dead portfolio construction. So this is not how you would run it in practice, although it doesn't change dramatically. Here, all we've done is we've taken all of their preferences on the long side, equal weighted them, all of their preferences that or the short side, as a short side, equal weighted those, and then run the portfolio. And you can see it does pretty well. There's a slightly, if I can find the right button, you know, there's a bit of a weird performance around here, which is sort of is post-March 09. But apart from that, it's pretty good performance. I'll come back to March 09 soon. We all know what happened in March 09, so you can sort of maybe see what's going on. The volatility skew. Now, I won't go through this. There's a lot of work we've done using implied volatility data. Again, this is from our trading systems. This isn't market data per se. The options skew, there's loads of details here. If anybody wants the slides, I'm not sure if the slides are made available. If they're not, if you want my slides, please just drop me an email. I'm just david.jessop@ubs.com. So if you want the slides, please let me know. But basically here, we're just looking at the options skew as a signal. Now, there's loads of ways of using the skew or measuring the skew. Every single academic paper you read has a different definition. So here we've just taken a really simple one of the 90% strike and the 110 strike. Very simple, just take the difference. And if you sort of trade that, and here we're trading this on a weekly basis, stocks with a low skew tend to outperform-ish, and stocks with a high skew tend to do badly. This is again from January 03, which is when our this data source starts. We've taken this data further back in the US, and you get a similar pattern of returns. You tend to find it doesn't do much during that very low volatility period up to about 07. So there, maybe our definition of the skew doesn't work very well. But you know, it's the right sign in that period. It's just not very good. There's not much signal. And then all of a sudden, as volatility picks up post-07, you get a much better signal. And I can take you through that, a classic Carhart regression if you're interested. You know, you've got a significant intercept on the low skew, and actually you have a significant negative on the high skew basket. So there's two signals. Those are two very stock-specific signals. Well, the first one's definitely stock-specific. This one you could argue, is this stock-specific or not? And the final point on this is what this really is, seems to be this sort of top decile of returns. That's the very high skew portfolio, just to point out over there as well. What this really seems to be is an avoidance effect. So what you really want to do here is avoid the stocks with very, very high skew. There's less information in the middle of the distribution. There's a little bit at the right-hand end. And also, as you can see, this bar chart here on the right, they have I really need two arms and be able to point in both directions at the same time, which is tricky. You also got they're very high risk. So you might not want to short them. That's the point as well, is do you really want to short a portfolio of highly volatile stocks? Because you get interesting geometric averaging problems if you run a long-short portfolio of that. So that's another one. The Growth Surprise Index. Now, this surprised me. What we're doing here is our economists monitor actual economic outturns, so various data. There's a whole long paragraph here. And they look at basically the outcome of economic data compared to the consensus forecast for it. They do this at a country level, and then they add it all up. And basically, it's a 1 or a -1. There's nothing more to it than that. So are you better than consensus or worse? And they put all of this together into a Eurozone index, and you get this indicator, this blue line here, which is this thing called the Growth Surprise Index. And you can see sort of going into March 2009, all the economic outturns, that's the blue line, were below consensus. It all picks up. Now, I have to say, I mean, there's obviously a hugely contemporaneous relationship with the market here. Hardly surprising. However, if you actually use the Growth Surprise Index to forecast next week's market return, I'm not saying it does brilliantly. I won't make that sort of claim. But basically, it has a hit rate of about 55%. So this is, if it went up last week, you buy the market this week. If it went down last week, you sell the market this week. Very simple strategy. Would you really do it like that? No, not at all. It's not. This is meant to be, and I mean, I really didn't think this would work, by the way. So this one did shock me. So there is some information in this economic news, and you can't get it if you use the market itself. You can't do the same trade with the market. It obviously doesn't work. There's no real autocorrelation in market returns. But somehow there is a bit of sort of, obviously some sort of momentum in growth surprises or outcomes for growth. I mean, would you really use this in this way? Well, probably not, but I'm putting it in here just as a type of proprietary data you could use. I'm sure you could do better than this. I guess here it's not the data that's proprietary, it's the methodology. Whoops, I just pressed the wrong button. Hopefully that one. Aha, there we go. So how do we take all this? Now, this is really the second half of what I want to talk about, is I've got all this data. How do I actually add it into my portfolio? And it sounds like in one sense, a really simple question. But for those of you obviously who are running portfolios, you'll know it isn't. But the first thing I think you have to do is think about and this is really, I guess, one of the things we want to sort of make a point about in this talk, is you have to think about what are your forecasts actually capturing. And if you think about this, I'm now sort of going into the world of linear factor models. So your classic sort of factor models where you've got factor type forecast, or you've got factors which drive returns, and they could be sectors, they could be countries, they could be value, growth, and momentum, and you've got stock-specific returns. Now, that's the point. You then need to say, if I've got a forecast of return, is it a stock-specific? Is it only capturing really stock-specific information, or is it capturing factor information? Now, and then the other half of that is then, if you've got something which I would argue, especially the alpha preferences, this idea of an analyst saying, these are my favorite stock against my least favorite stock, that's a stock-specific forecast. There's no market information in there. There's no sector information in there. There may be a little bit of star. There may be a few, some things in, but basically that's a stock-specific forecast. Whereas obviously the growth index example at the end, that's a market forecast. That's a factor forecast. And the skew you can sort of think of either way, really. I'm not quite convinced it's a stock-specific one, but you could think about that. So what you have to be able to do is to say, first of all, think about what are you forecasting? Because that tells you how you then want to use the forecast. And sometimes, as I'm going to show you now, you have to neutralize your forecast to your risk model. So to basically take any factor risk out of your forecasts. And you can do that partly by how you build the forecast and how you put the forecast together. So with alpha preferences, you build it in a market neutral way, you build it sector neutral and everything else. But then you can do a little bit of algebra to pull it all together. Now, I decided as I've got quant on my business card, I should throw in a few equations. And this lot's really simple, just a straightforward linear factor model, just to give you the notation we use. So here, B, capital B, is our betas. F is our factor covariance matrix, and D is our diagonal stock-specific covariance matrix. All very obvious notation. And so your covariance of your total returns, V, is just BFB plus D. So now what we can do is we can say, and now by the way, why is all this important? Well, if you're trying to use an optimizer, let me sort of give you why we need to think about this. People try to use optimizers for building portfolios. And every so often they try and they often give up and they come back to it and they give up. Why? Well, we all know the problems with optimization. The results can be very unstable. The results can generate vast amounts of turnover. Can. I'm not saying always do. I'm saying can, before anybody picks me up on that. They're very sensitive to errors in the whole forecast, in the way you do this. So anything you can do to process your signals, to process your forecasts before you use an optimizer tends to be a good thing, especially when we're now going down this route. And especially if you're thinking about running just a purely stock-specific forecast, actually taking out all the factor sensitivities is great because optimization is then really easy. You just take your signal and divide by the stock-specific variance. That's it. That's optimization for you. It's done. So what we have to do is we can basically split our signal up into factor forecasts and stock-specific forecasts, as I say. Now, why is this a good idea? There's a whole set of algebra here. There's the bit at the bottom where I comment about, make sure you hit the right button. If we just use, actually let me go back. So the idea is here we're breaking our forecast into G, which is our factor forecast of our factor returns, and alpha hat I used, which is your forecast of your stock-specific returns. Okay, if all you're using is stock-specific returns, you've got a very nice solution to your optimization, which is what I said, which is just d to the minus 1 times alpha. It's robust, it's stable, it doesn't change, it doesn't trade particularly much, the turnover is very low. All things as a broker I really shouldn't be encouraging. But it is, it's a really good solution. Now, a good example, why is this important? I've just given you a bit of algebra. It's very simple ideas, but why is it a good idea? Well, take back to our alpha preferences. March 09 to, I'm just trying to look at the exact date, October 09, we lose money. Not a lot, we lose 5–10%. What's going wrong? Well, we neutralize this portfolio. So we start with our portfolio, which is W. We calculate some implied alphas out of that, which is the mu in this case. We then use our neutralization equation to just strip out the alpha hat bit, is we get rid of any factor forecast at all from our analysts. Because that's not what they do. We don't pay them to forecast factors. We pay them to understand their companies in the little group of companies they manage. So they shouldn't be forecasting the market. They shouldn't be even forecasting momentum or value, really. I mean, they'll be using them perhaps, but they shouldn't be forecasting them. If you do that, and you rebuild your portfolio using the equation at the bottom there, so here I want to use W star as my weights. Well, actually, first of all, what do we find? Well, what we find is this is the implied forecast of the market. Ignore the scale. The scale is sort of irrelevant. But this is the implied market view of our analysts in aggregate. When is it the most negative? March 09, just about. What happened in March 09? The market rallies really strongly. Unsurprisingly, we underperformed. If you take that out, which is the lighter blue line on this chart, actually we do quite well. I mean, it doesn't make money particularly over that period, but it doesn't really lose any money. So what we've done there is we've taken our signal, taken out any factor returns at all, and then just built a portfolio from it. Very simple, very straightforward. It's as I say, it's 2 lines of algebra. You can do it really quickly. But all of a sudden, we've got a much better quality signal. And interestingly, apart from that, actually, it really doesn't make a lot of difference to the returns in any other period. If you do this in our alpha preferences in different markets, you get different pictures, but the story tends to be the same. If you've got analysts making forecasts, getting rid of their factor views is a good idea, because it's not what they're good at. So how do we put them all together? Now, this is where I sort of slightly hesitate. I'm not going to go through a vast amount of detail. If people are interested, do come and talk to me. So again, we're going to start from our very simple basic portfolio, third momentum, third quality, third value. It's not meant to be a real fund. It's just meant to pick up the basic idea of what quant factors are doing. And then the blue line is the combination of the 3. So from December 07 to slightly earlier this year, a few weeks ago, it's not very good, basically. Not much has happened. You made a bit of money in December 08, you lost it, and so on. So that's a starting point, and it starts in, say, 08, because that's when our final lot of data all starts. Now, our solution to this, and I really am not going to go through the maths, as I say. If people are interested, I'll send you the paper, we can talk you through it. Our view is this: you do this in a Black-Litterman world. And in fact, I think somebody's talking about that tomorrow as well in one of the sessions. Black-Litterman is really easy in a sense. It's just Bayesian, so a bit of Bayesian sort of arithmetic or Bayesian sort of probability theory. And what we start with is you say the markets know something, which is basic consensus. I've got some private information, which in this case is the stuff I've talked about, and we put it all back into build a portfolio. Now, it turns out you can do, I'm not going to go through all this stuff. I mean, this is our framing of it in sort of information theoretic way. But you get this sort of formula at the bottom, which is quite neat. So basically, you've got a set of forecasts, which are G. I've got a set of portfolios, which it all sort of just works very nicely, and it's very easy to use. And the advantage of it is, effectively, if you have no constraints, if you use Black-Litterman, what your solution is, I've got all these forecasts P, all these portfolios P, which I'm forecasting, which can be stock specific, they can be factors, doesn't matter. But each P, each line, each row of this P matrix is a forecast, and G are just my forecast of return. Effectively, if you've got no constraints, you get this lovely sort of, well, you can see either bit of it. You're basically just weighting your forecast together by some adjustment of your actual forecast of returns. It's a really simple formula. Black-Litterman is made, and I know going through it in this speed, I can't say I'm necessarily solving this problem. Black-Litterman is often dressed up at being really, really complicated, and it's not. It's just some very simple algebra, and it's all matrix multiplication. You can use it in MATLAB or R or whatever you like. In fact, you can probably even just about do this in Excel. And the idea is, I mean, the nice thing about Black-Litterman, again, back to one of our views about all these portfolio construction techniques, is if you don't change what you're forecasting, so the P, then you don't tend to generate any turnover. And that's important. I mean, that's a good thing, because we know that turnover is just cost. It's very rarely anything but cost. So if you don't change your forecasts, you don't change your portfolios. That's one of the best things to us about Black-Litterman. It's very hard to make any categorical statements about which way of doing portfolio construction is good. There are loads of academic papers out there that claim to try to do it. They're all a load of rubbish, I have to say. They all run 3 examples and then say my approach is the best. Complete dreadful. You just can't do anything, but you can look at these things like turnover. You can extend it into the really scary slide with vast amounts of matrix algebra on there, which I'm not even going to attempt to touch. But basically, you can put lots of different forecasts into this framework. So what happens when we put this all together? Well, in a sense, you know where this is going, because I've shown you some back tests or some out-of-sample tests of various proprietary factors that make money. We have our basic quant factors, which didn't do really much, and you can sort of guess where this is going to end up on the next slide. But just to set you up for this, so we've got our basic quant fund, so 3-factor forecasts of momentum, value, and quality. Obviously, those are factor forecasts. Those are factors actually in our risk model, or we can put them into our risk model. And again, there was a very nice paper by Dan Stefak from Barra, which said that was exactly the right thing to do. We have a factor forecast on the first factor in the risk model, which is the market, and that seems to make money, surprisingly. We have a portfolio, what we call a portfolio forecast, probably of the skew, and then we have this set of stock-specific forecasts and alpha preferences. Now, in practice, the thing is, if you try to do this in lots of other ways, it would just be really tricky to do this. If you throw it into this Black-Litterman algorithm, it just works. You just generate your portfolios, do a bit of matrix multiplication, and out drops the answer. And what do you get? Well, unsurprisingly, as I say, you sort of know where this is going. You make money from it. So what's this? And the nice thing, I will say there's no transaction costs in this backtest. It isn't meant to be because you say you'd put a lot more slightly deep nuances in actually how we built all these forecasts if we were doing this in practice. You'd still make money out of it. I'm not denying that. I'm just saying it wouldn't look exactly like this. And we haven't put any transaction costs in. So actually, both of your lines would be a bit lower. So what's the real story here is there's 3 things. Is you can use our point is you can use analyst data to make money. Not all analysts, I will say. I've had colleagues try to do this with other companies, and it doesn't necessarily work as well. I won't even say you can necessarily do it with all UBS analysts. I won't try and claim that much. But I didn't have to torture the data to get these results. But you need to think about how you're using the data. The real point of all this is you need to think about how you actually put these factors together. What are you actually forecasting? Are you forecasting stock-specific returns? Are you forecasting portfolios? That's the real point of all I'm trying to say here is getting proprietary data is one part of the problem. But there's lots of it out there, especially in the US. There's loads of interesting data sources out there. My favorite is a company that uses satellite imagery to count the cars in shopping mall car parks and uses that to forecast same-store sales. Absolutely brilliant. Don't know if it works. We've never actually tried the data, but it's such a good story. And there's loads of that data out there. But again, you still need to think about what it's doing. What is it actually forecasting? And then, as I say, you need to think about the portfolio construction techniques of how to combine all these things together. Our solution is very much to go down this Black-Litterman route because it's stable. It doesn't tend to encourage turnover if you're not really changing your forecasts. It doesn't, and I say it just sort of works. I mean, that's a nice thing about it, is it's very simple. It's nothing really complicated about the whole Black-Litterman stuff, and it just works. And the only catch with the whole thing is you've got to use one risk model through the whole process. And ideally, that's a risk model that you've built with any of your, especially if you're using value and momentum in the starting point, you should put those factors actually into the risk model. So with that, I'm aware that we're running sort of slightly behind time, so I've sort of tried to keep it sort of slightly short. I think, however, there's probably a little bit of time for some questions if people are interested. Or I might have stunned everybody into silence.
Okay, if we're not stunned into silence, who's going to kick us off for questions? A lot to go through. There's a question over here.
There's one over there and one.
Evgeny from the FX market. Just curious if you've used any FX data to correlate with equities.
Have we used FX data? No, we've looked. We find using FX with equities is very hard because you get very long-term trends in FX. And the problem is if you're not careful, you end up picking up equity market trends that just happen to be at the same time as your FX market. So if you look around the tech boom, there are various currency trends around the same period. So it looks like certain stocks are really highly correlated to the currency. And it's got absolutely nothing to do with that. So we find using anything to do with FX into equities because of this trending behavior is very tricky. And you've got to be very careful of picking up other way around. You tend to pick up a vast number of spurious correlations or spurious relationships. The same is true, actually, of a lot of macro data. I mean, I'd put FX into sort of a certain bucket of macro data. The same can be true. You can use the oil price. You can find Boots, the old Alliance Boots, the pharmacy, the chemist shop, always used to be really sensitive to the oil price. No idea why. It just happened to have the trend that fitted. There's a few other of those. The other one with currencies, actually, was the Far East Asian markets are very sensitive to the Norwegian kroner. Now, if anybody can come up with a story as to why sort of Hong Kong and Singapore equities are sensitive to the Norwegian kroner, I would love to hear it. But that's the problem, is we just know it's a stupid result. I mean, that's easy to spot. There's others where you sort of worry, are you really spotting it? So we have tried with little success, I have to say.
Okay, there's another question from Elliot.
Hi, we're a big fan also using Black-Litterman, or the reverse optimization methodology. One of the questions, though, that keeps coming up is the fact that it's still based upon a multivariate normal model. And especially with the types of strategies you talked about that could be used to supplement other strategies, they're, by their nature, sort of asymmetric or heavy-tailed or whatever. What's your thoughts on that? Do you use other things to supplement it? Do you see this as a major limitation?
I mean, where to start? I mean, in this case, we don't. I mean, a lot of what we're doing here is we're trying to forecast relative returns, not absolute returns. That's one of the. That is actually one of the insights we've had with a lot of doing this portfolio construction work. Is trying to use absolute returns is a nightmare because nobody can do it particularly well. If you can go into a relative return space, people are better at relative returns. Also, in relative return space, slightly you get away from the lack of normality, or the lack of normality problem becomes a bit of a less of a problem, I'd say. If that makes sense. I mean, however, there isn't really any reason in the Black-Litterman framework, if you go right back into the pure Bayesian stuff, there's actually no reason you can't use Black-Litterman with completely weird distributions, or the idea of the Bayesian combining of forecasts with lots of weird distributions. The problem is it's just completely intractable. You know, you can get a solution, but your intuition behind the solution tends to go away a little bit, which is one problem. And it's a numerical solution. It's not an analytical one. So yes, you can do it, but it gets a bit ugly. Now, I think, again, it depends where you're using it. If you're using it in a single stock framework, you've got lots and lots of stocks. A lot of these problems, to some extent, slightly go away, average out, if you want to say that. I mean, I won't say you can ignore them, but you can be slightly less concerned. If you want to use an asset allocation where you've got a lot fewer assets, then yes, I think I think also you become a much bigger problem. And especially if you think, like, take Greece at the moment, or take Europe as a whole at the moment, you can argue that your forecast of returns for Europe are distinctly non-normal. There may be a combination of normals, but the chances are either the Greek solution, Germany decides to pay, everything shoots up, or actually Greece goes out of the euro, everything collapses. You know, you've probably got sort of two humps in your forecasts. So yes, you can use that, you can do it, but as I say, your intuition goes haywire. And one of the things we quite like about this, and it's something I didn't have time to talk about, is one of the things you can use Black-Litterman with is you can actually get this idea of forecast auditing. So you can start taking your forecasts, looking at what they are implying in your factor model, and also asking the question, are two forecasts consistent? In other words, are they likely both to be true? I mean, my favorite example of that was back in about 2001, just before I joined UBS. Our then US strategist was sort of forecasting the US going up 20%, and our UK strategist was forecasting the UK going down by 20%. There is no way that those two forecasts are true. Absolutely not. Now, which one's wrong is a different point. The idea of auditing these forecasts doesn't tell you that, but it can tell you that if you put those two forecasts into this process, you're going to get a mess. So that's another thing you can do with Black-Litterman, or like an extension of the Black-Litterman idea. But yes, you're right, the lack of normality is a problem. And there are ways around it, but they're not nice.
Fantastic. Can we just give David a massive round of applause, please?